Welcome to the Punk Capitalist channel. In episode 3, we covered the first important idea of Granddaddy Punk, which was the margin of safety. In this episode, we will cover the second important idea, the investor and stock market fluctuations. This was touted by the old fart, Warren Buffett, as the most important chapter on investing ever written. The old fart has mentioned on different occasions that investing is a game that requires temperamental qualities rather than purely intellectual qualities. Why is that so? We will look at what Granddaddy Punk has to say about this from excerpts from Chapter 8 of The Intelligent Investor. First written in 1949, while a long time ago, still rings true because human nature remains the same. Let's begin. The investor should know that his stock portfolio is almost certain to fluctuate in value over any period of several years. Knowing this possibility, the investor should be prepared for it both financially and psychologically. He will want to benefit from changes in the market levels, through an advance in the value of his stock holdings as time goes on, and perhaps also by making purchases and sales at advantageous prices. While all of us want to buy low and sell high, it involves the very real danger that it will lead to speculative attitudes and activities. It is easy to tell you not to speculate. The hard thing will be for you to follow this advice. If you want to speculate, do so with your eyes open, knowing that you will probably lose money in the end. Be sure to limit the amount at risk and to separate it completely from your investment program. Market fluctuations as a guide to investment decisions. Since common stocks, even of investment grade, are subject to recurrent and wide fluctuations in their price, the intelligent investor should be interested in the possibilities of profiting from these pendulum swings. There are two possible ways he may try to do this: the way of timing and the way of pricing. Timing means the endeavor to anticipate the action of the market, to buy and hold when the future course of the market is deemed to be upward, and to sell or refrain from buying when the course is downward. Pricing means the endeavor to buy stocks when they are quoted below their fair value, and to sell them when they rise above fair value. A less ambitious form of pricing is the simple effort to make sure that when you buy, you do not pay too much. While we are sure that the intelligent investor can derive a satisfactory results from the endeavor of pricing, we are equally sure that if he places his emphasis on timing, in the sense of forecasting, he will end up as a speculator and with a speculator's financial results. This distinction may seem rather tenuous to the layman, and it is not commonly accepted on Wall Street. Wall Street is wedded to the principle that both investors and speculators in stocks should devote careful attention to market forecast. The farther one gets from Wall Street, the more skeptical one becomes of market forecasts or timing. Yet most of us still pay attention and sometimes even act on these forecasts. Why do people do it? The general public has been persuaded that it is important for us to form some opinion of the future course of the market, and because they feel that the analyst's forecast is at least more dependable than their own. A great deal of brain power goes into this field, and undoubtedly some people can make money by being good stock market analysts. But it is absurd to think that the general public can ever make money out of market forecast. For who will buy when the general public, at a given signal, rushes to sell out at a profit? If you expect to get rich over the years by following some system or leadership in market forecasting, you must be expecting to try to do what countless others are aiming at, and to be able to do it better than your numerous competitors in the market. There's no basis in logic or experience for assuming that any typical investor can anticipate market movements more successfully than the general public, of which he is himself a part of. There is one aspect of the timing philosophy which seems to have escaped everyone's notice. Timing is of great psychological importance to the speculator because he wants to make his profits in a hurry. The idea of waiting a year before his stocks move up is repugnant to him. But a waiting period as such is of no consequence to the investor. What advantage is there to the speculator in having his money uninvested until he receives some, presumably trustworthy signal that the time has come to buy? He enjoys an advantage only if by waiting he succeeds in buying later at a sufficiently lower price to offset his loss of dividend income. What this means is that timing is of no real value to the investor unless it coincides with pricing. That is, unless it enables him to repurchase his shares at substantially under his previous selling price. Market fluctuations of the investor's portfolio. Every investor who owns common stocks must expect to see them fluctuate in value over the years. The behavior of the Dow Jones Industrial Average from 1964 to 1971 probably reflects pretty well what has happened to the stock portfolio of a conservative investor who held a portfolio of large, prominent, and conservatively financed corporations. The value of that portfolio gyrated between 631 to 995. On average, the portfolio was around the 890 level, because individual issues of the Dow set their high and low prices at different times. Individual stocks fluctuated more wildly than the Dow as a whole. Shares of companies not in the Dow, also called secondary companies, fluctuate more widely than the major ones. But this does not necessarily mean that a portfolio of well-established but smaller companies will make a poorer showing over a fairly long period. In any case, the investor may as well resign himself in advance to the probability rather than the mere possibility that most of his holdings will advance, say 50% or more from their low point, and decline the equivalent 1/3 or more from their high point at various periods in the next 5 years. A serious investor is not likely to believe that the day-to-day or even month-to-month fluctuations of the market make him richer or poorer. But what about the longer-term and wider changes? Here, practical questions present themselves, and the psychological problems are likely to grow complicated. A substantial rise in the market is at once a legitimate reason for satisfaction and a cause for prudent concern. But it may also bring a strong temptation toward imprudent action. Your shares have advanced, good. You are richer than you were, good. But has the price risen too high, and should you think of selling? Or should you kick yourself for not having bought more shares when the level was lower? Or worst thought of all, should you now give way to the bull market atmosphere, become infected with enthusiasm, the overconfidence and the greed of the general public, of which you are a part of, and make larger and dangerous commitments? The answer is a self-evident no, but the intelligent investor is likely to need considerable willpower to keep from following the crowd. If he is the right kind of investor, he will take added satisfaction from the thought that his operations are exactly opposite from those of the crowd. Business valuations versus stock market valuations. The impact of market fluctuations upon the investor's true situation may be considered also from the standpoint of the shareholder as the part owner of various businesses. The holder of marketable securities actually has double status, and with it the privilege of taking advantage of either at his choice. On the one hand, his position is analogous to that of a minority shareholder or silent partner in a private business. Here his results are entirely dependent on the profits of the enterprise, or on a change in the underlying value of the asset. He would usually determine the value of such a private business interest by calculating his share of net worth as shown in the most recent balance sheet. On the other hand, the stock investor holds a piece of paper, which can be sold in a matter of minutes at a price which varies from moment to moment, which is often far removed from balance sheet value. However, the true investor scarcely ever is forced to sell his share, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book, no more. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other people's mistakes of judgment. Incidentally, a widespread situation of this kind actually existed during the Dark Depression days of 1931 to 1933. There was then a psychological advantage in owning business interests that had no quoted market. For example, people who owned first mortgages on real estate that continued to pay interest were able to tell themselves that their investment had kept full value. On the other hand, many listed corporation bonds of even better quality and greater underlying strength suffer severe shrinkages in their market value, thus making their owners believe they were growing distinctly poorer. In reality, the owners were far better off with the listed securities, despite the low prices of these, because if they wanted to, they could have sold the issues, possibly even exchanged them for better bargains. Or they could have just as logically ignored the market's action as temporary and basically meaningless. But it is self-deception to tell yourself that you have suffered no shrinkage in value merely because your securities have no quoted market at all. Mr. Market. Imagine that in some private business you own a small share that cost you $1,000. One of your partners, Mr. Market, is very obliging indeed. Every day he tells you what he thinks your interest is worth, and furthermore offers either to buy you out or to sell you an additional interest on that basis. Sometimes his idea of value seems plausible and justified by business developments and prospects as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems to you a little short of silly. If you are a prudent investor or a sensible businessman, will you let Mr. Market's daily communication determine your view of the value of a $1,000 interest in the enterprise? Only in case you agree with him or in case you want to trade with him. You may be happy to sell out to him when he quotes you a ridiculously high price, and equally happy to buy from him when this price is low. but the rest of the time you will be wiser to form your own ideas of the value of your holdings. Based on full reports from the company about its operation and financial position, the true investor is in that very position when he owns a listed stock. He can take advantage of the daily market price or leave it alone as dictated by his own judgment and inclination. He must take cognizance of important price movements, for otherwise his judgment will have nothing to work on. Conceivably, they may give him a warning signal which he will do well to heed. In plain English means that he is to sell his shares because the price has gone down, foreboding worse things to come. In our view, such signals are misleading at least as often as they are helpful. Basically, price fluctuations have only one significant meaning for the true investor. They provide him an opportunity to buy wisely when prices fall sharply and to sell wisely when they have advanced a great deal. At other times, he will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. Thank you for listening until the end of the video. Granddaddy Punk's message here is of supreme importance to the true investor. If you look at stock market fluctuations in this way, you will, in the long run, be a more successful investor. Good investing requires patience. Please like and subscribe if this resonates with you.